In the space of a single coffee break, tens of billions of dollars can appear to evaporate. In recent market turmoil, multiple major crypto tracking and exchange-adjacent outlets circulated a striking figure, roughly $40 billion of crypto market value gone in about 30 minutes. But here is the first hard truth. That exact 40 billion in 30 minutes number is not a single official statistic with one universally agreed measurement method. It is a framing that shows up in posts and exchange content, and it depends on which index you use, which coins you include, and how you define gone. Some versions describe total market capitalization across thousands of tokens. Others describe Bitcoin's market value. Others confuse liquidations with market cap. Still, the underlying event is real. A sudden synchronized drop, fast enough to trigger liquidations, fast enough to snap through stop orders, fast enough to remind everyone that this market, for all its technology, still runs on the oldest fuel in finance, leverage and fear. And if you think this does not affect you, listen closely. Because when a market can lose that much value that fast, it is not just a crypto story, it is a liquidity story, a confidence story, a plumbing story. And those stories always end up touching everything else. What happened? Why it happened? And what it suggests about what comes next. That is what becomes clear today. This is not conspiracy. This is visible in the data, in the way derivatives are structured, in the way liquidations work, in the way stablecoins behave under stress, in the way global risk sentiment moves when rates stay high and liquidity tightens. Institutions have been warning about this exact fragility for years in plain language. The Bank for International Settlements has repeatedly described how crypto's market structure amplifies runs, leverage spirals, and feedback loops. The IMF has spent the last several reporting cycles mapping stablecoin run risk and spillovers to the broader financial system. U.S. regulators, through Treasury-linked stability reporting and cross-agency risk language, have treated certain parts of this ecosystem as a familiar problem wearing a new costume, and independent market data from widely used dashboards that track liquidations and open interest has shown the same pattern again and again. A crowded trade builds quietly, a small trigger hits, then the selling is no longer voluntary, it is forced. In crypto, the crash is never only a crash, it is a machine completing its cycle. To understand why tens of billions can vanish in minutes, the only useful approach is pattern recognition. Not hype, not slogans, not tribal loyalty, a framework. One that has described asset booms for centuries: ascension, overextension, silent exodus, collapse, and reset. 4 stages, simple, repeatable, almost mechanical. Ascension is when a new asset or a new system feels like liberation. Participation grows. Liquidity feels endless. The story writes itself. Early adopters become evangelists. Risk feels like courage. Overextension is when the asset stops being owned and starts being used. As collateral, as a leverage base, as a casino chip for bigger bets. Lending expands. Derivatives expand. Complexity expands. And the system becomes fragile, not because prices are high, but because the structure underneath requires prices to stay high. Silent exodus is when the smartest money stops selling the story and starts selling the asset. Quietly, gradually, often while publicly staying optimistic. Liquidity begins thinning at the edges. Market depth looks fine until it is tested. Collapse and reset is when a trigger arrives in a system that is already unstable. Forced selling cascades. Confidence breaks. The market searches for a price where leverage is gone and weak hands are exhausted. Then the cycle restarts with different winners, different rules, and usually a different set of institutions claiming they saw it coming. That is the pattern. And it is older than crypto. Case study 1 is the South Sea bubble of 1720. Ascension came first, a company tied to imperial trade and government finance. A story of guaranteed riches. Participation exploded. Shares surged. Credit expanded. The public wanted in. Overextension followed. The bubble became self-funding. Speculation fed speculation. People borrowed to buy shares. Promoters engineered demand. Prices divorced from cash flows. The structure required continued optimism to survive. Silent exodus arrived before the headlines did. Insiders and connected players reduced exposure while the public rushed in. The market still looked strong on the surface. Then collapse. Confidence snapped. The selling fed on itself. Credit tightened. Fortunes disappeared. Parliamentary inquiries followed. Careers ended. The reset came through political fallout, regulatory reaction, and a public that suddenly remembered that stories are not balance sheets. The technology did not matter. The mechanism did. Leverage, narrative, thin liquidity, sudden reversal. Case study 2 is the 1929 stock market crash and the early phase of the Great Depression. Ascension in the 1920s was built on industrial expansion and the belief that modernity had abolished the old rules. Participation surged. New investors arrived. Brokers made it easy to borrow against stocks. Overextension was margin. A system where small price declines forced investors to sell. Selling pushed prices lower. Lower prices triggered more margin calls. And the market became a machine that could only move upward safely. Silent exodus appeared in the data before it appeared in the public mood. Some sophisticated investors reduced risk. Liquidity conditions tightened. Volatility rose. The market's internal health weakened. Then collapse. Selling became forced. Prices fell faster than people could process. Banks and brokerages felt the shock. The real economy followed as credit contracted. Again, the trigger was not the point. The structure was. Case study 3 is the 2008 global financial crisis. Ascension began with a long period of stable growth and falling volatility. Housing became a story of permanence. Financial engineering promised to distribute risk safely. Ratings gave comfort. Capital poured in. Overextension was leverage built on leverage. Mortgages pooled into securities. Securities sliced into tranches. Tranches packaged into new products. The system depended on the assumption that liquidity would remain available and that house prices would not decline nationwide. Silent exodus happened through early cracks, rising delinquencies, widening spreads, quiet repositioning. But many investors stayed because exiting meant admitting the story was wrong. Collapse and reset came through a chain reaction. Funding markets froze. Institutions failed or were rescued. Central banks intervened. The system survived, but only after a brutal repricing and a new era of regulation, emergency liquidity, and political resentment. These 3 case studies are not crypto stories. They are structure stories. And crypto, despite its language of decentralization, has built a structure that can behave like the most centralized, fragile systems in history. Now map the pattern to today. Crypto's ascension phase was obvious. Bitcoin's rise from niche experiment to global macro asset. Ethereum's rise as a platform, the explosion of tokens, the growth of exchanges, the entry of institutions, the rise of stablecoins as the settlement layer. The story shifted from rebellion to integration. Overextension came next, not just higher prices, but the transformation of crypto into collateral, into a leveraged ecosystem where perpetual futures, options, and cross-margin accounts allow traders to control massive exposure with small equity. This is where the fast crash lives. Because when a market is dominated by leveraged derivatives, price moves stop being reflections of opinion. They become mechanical events. A liquidation is not a choice. It is an exchange closing a position because the collateral is insufficient. When enough positions are liquidated at once, the market receives a surge of sell orders that are indifferent to price. That selling pushes prices lower. Lower prices trigger the next wave of liquidations. That is a cascade. And it is why crypto can fall in minutes in a way that feels supernatural to outsiders. The existence of liquidation tracking dashboards has made this visible in real time. Major market outlets regularly cite these figures during sharp moves, including 1-hour liquidation totals approaching $1 billion in certain episodes, as reported via widely referenced liquidation data providers and echoed in mainstream financial coverage. The exact totals vary by provider and methodology, but the phenomenon is consistent. Fast drops coincide with concentrated forced deleveraging. Mentions of nearly $1 billion liquidated in a single hour have appeared in major finance coverage using CoinGlass reported figures. Now return to the title claim. 40 billion gone in 30 minutes is a market cap framing seen in multiple posts and exchange content, and it is not a standardized official statistic. It is best treated as a reported estimate, not a confirmed audited number. It appears in exchange content and social media commentary that describes a rapid drop in aggregate market value. But the deeper truth is more important than the exact figure. A move of that magnitude in that time window is plausible in a market with multi-trillion-dollar aggregate capitalization, because market cap is price times supply, and the supply number does not need to change for the headline value to change. When prices slip across the board, the value disappears instantly on paper, and that paper value matters because it interacts with leverage. When prices fall, collateral values fall, and when collateral values fall, risk engines tighten. When risk engines tighten, positions are closed. When positions are closed, prices fall further. That is the loop. Now add stablecoins. Stablecoins are often described as the calm center of crypto, the dollar substitute, the bridge to traditional finance, the settlement rail. But official institutions have emphasized the run risk embedded in any promise of redemption at par, especially under stress. The IMF has discussed stablecoins as carrying macro-financial stability risks and has laid out the basic vulnerability, a loss of confidence that redemption at par will hold. The Federal Reserve's research has also explored how stablecoins can interact with runs in funding markets and how stablecoin dynamics can matter beyond crypto in certain conditions. In normal times, stablecoins lubricate trading. In stress, they can become a transmission channel, because when people want out, they do not always sell into dollars in a bank. They sell into stablecoins, then they try to redeem stablecoins, or move them, or dump risky assets for stable liquidity. And that pressure can amplify dislocations, especially if redemption infrastructure, reserves, or market confidence becomes questioned. Now add the macro environment. Crypto is often marketed as separate from central banks, but price action has repeatedly demonstrated sensitivity to global liquidity conditions. When policy rates are high, the free money era ends. Risk appetite changes. Carry trades unwind. Dollar strength can tighten global financial conditions. Speculative assets become more fragile. This is not ideology. This is basic finance. In that environment, the silent exodus phase can look like this. Volume concentrates in fewer hands. Market depth becomes thinner. ETF flows become a headline driver for Bitcoin specifically. When inflows are strong, price support looks durable. When outflows appear, sentiment can turn quickly. Recent reporting has described notable outflow days in U.S. spot Bitcoin ETFs during periods of price weakness, reinforcing that new channels of institutional access can also become new channels of institutional risk-off behavior. And when those flows shift at the same time as leverage is elevated, the market becomes extremely sensitive. Now, what happens next? Not prophecy, mechanism. If leverage remains high, then future drawdowns remain capable of becoming cascades. That is measurable. Watch funding rates. Watch open interest relative to spot volume. Watch how quickly liquidations spike when price slips through key levels. If liquidity continues tightening globally, then speculative demand tends to shrink. That does not mean crypto goes to zero. It means the distribution of outcomes widens. The market becomes more dependent on marginal flows. That increases instability. If stablecoin market structure strengthens through regulation, transparency, and reserve clarity, then one major tail risk can diminish. If it does not, then confidence events remain possible. Not guaranteed, possible. If institutional integration continues, then crypto becomes less isolated. That cuts both ways. It can bring more stable long-term capital. It can also bring correlated selling during risk-off episodes. The key is that the 30-minute wipeout is not a one-time shock. It is a demonstration. It is the system showing its true operating characteristics. Now the objection. This time is different because technology will save us. Technology can change speed. It can change access. It can change distribution. It does not delete leverage cycles. A liquidation engine is still a liquidation engine, whether it runs on a trading floor with phone calls or in an automated matching engine at internet speed. If anything, automation compresses time. It turns what used to be a slow collapse into a fast one. They can print forever. Central banks can expand balance sheets. Governments can run deficits. But printing does not guarantee stability in every asset. Liquidity injections can support markets, but they also have costs, including inflation risk, credibility risk, and political backlash. And even when liquidity returns, it does not save over-leveraged positions in real time. It often arrives after the damage is done. Reserve status prevents collapse. Reserve status can delay. It can cushion. It can shift where pain appears first. It cannot repeal arithmetic. Empires with reserve-like privileges have still faced devaluations, restructurings, and resets when debt burdens became incompatible with political constraints. The mechanism is not collapse overnight. It is erosion. It is volatility. It is periodic crisis. Crypto is not a reserve currency system in the classical sense, but it is plugged into one, and that means its crashes are shaped by the same capital cycle forces. Now the practical takeaways. This is not financial advice. It is risk hygiene. First, understand the difference between volatility and fragility. Volatility is price movement. Fragility is structure. A fragile market breaks when stressed. Crypto's structure, heavy in leverage and momentum, can be fragile in exactly the way the title describes. Second, treat liquidity like oxygen. In a panic, the asset that can be sold quickly at a predictable price becomes priceless, not because it earns the most, but because it prevents forced decisions. Third, respect debt. In every historical cycle, leverage is what turns a downturn into a disaster. For households, it is adjustable payments and job risk. For traders, it is margin. For systems, it is short-term funding. Fourth, diversify conceptually, not just across coins, across risk types, across time horizons, across income streams. The most resilient people in financial shocks are rarely the ones who guessed the right asset. They are the ones who could survive being wrong. Fifth, protect attention. In fast markets, misinformation spreads faster than price. Do not let viral numbers substitute for understanding. Even the title number here must be treated carefully. Reports and posts can compress complex events into a single dramatic statistic. The right response is not dismissal. It is verification and mechanism. Now return to the beginning. A sudden drop. A headline figure. 40 billion gone in 30 minutes. Whether that exact number is the correct measurement or an estimated framing, the event it describes is a real phenomenon. A market structure capable of erasing massive paper value at machine speed. And that is the point, because history does not repeat in costume. It repeats in mechanics, ascension, overextension, silent exodus, collapse and reset. The only question is where the system is inside that cycle right now, and whether participants can recognize the stage before the next forced move makes the decision for them. If the indicators of leverage and liquidity remain stretched, then future 30-minute events remain possible. Not inevitable, possible. And when they happen, they will not be explained by mystery. They will be explained by structure. Subscribe for the next documentary, where the focus shifts from the crash itself to the indicators that quietly predict instability before the headlines arrive, and the assets and behaviors that have historically preserved purchasing power without promising miracles. Was this crash, in your view, a one-off shock, or a symptom of a deeper leverage regime? And what signal would convince you the cycle is truly resetting?